Hello and welcome to Switzer Investing. I'm Peter Switzer, and in tonight's show we're going to look at a number of stocks that really have had a shocker this year, and we ask our experts, should you sell this before June 30, take your losses, use those losses to reduce your capital gain, and then maybe think about buying them later on when they start showing a bit more promise. The stocks I'm going to be looking at are AMP, Lendlease, McPherson, Pure Foods Tasmania, Pushpay, and that controversial Nuix. Taking the first shot at these will be Julia Lee from Birmingham Invest, then Adam Dawes of Shaw and Partners, and then I've got Michael Knox, the Chief Economist at Morgans in Brisbane. Michael's one of the smartest guys around when it comes to econometrics. He's the guy who told us when the Aussie dollar was around 65 cents, 66 cents, that it would be heading off towards 80. Got as high as about 70, 78, nearly 79. Now it's dropped down to about 74.55 US cents this morning. When I interviewed Michael Knox said that a dollar is going to go back up into the 80s. He's still pretty confident about that. And I've got to say his form when it comes to things like the dollar and markets is pretty damn good. Finally, poor Rickard, he's going to look at the fact that term deposits have now hit their low. The interest rates are low and are on the rise. Paul's going to look about the kinds of investments out there that you want to put money in to get fixed income returns, and which ones look good and which ones look like they're worth rejecting. That's the show. Let's kick off with Julia Lee. Well, it's that time of the year when people start thinking about dumping stocks that really let them down. I've given Julia Lee a list of ones that someone I know very well has had them stuck in their portfolio and wonders whether they should get rid of them. So none other than Julia Lee to review these. Julia, good to talk to you.
Good to talk to you too, Pete.
Okay, let's kick off with a well-known one, AMP. If you held AMP in your portfolio, would you hang on to it or would you sell it and use the losses?
It's a hard one because AMP, in its business, we know that still there are outflows. So funds are leaving the company, which of course isn't a great place to be. But the only reason that you'd be holding on to AMP is because it's up for sale. So you'd be hoping that AMP Capital gets a good price. And in that, AMP is probably worth about $1.50 and it's trading just below $1.20 at the moment. So look, there is potentially some upside there. Of course, the longer they don't get a bid, the less the company is worth, because we are still seeing institutional mandates leaving the company. They're losing staff. So the longer this drags on, the more painful it gets for AMP shareholders. But I think for the time being, you'd be holding out, still hoping for a bid, because that's what they're looking to do.
Okay, let's go to Lendlease now. Good company. It changed a lot of its internal work. I think at times you've liked Lendlease, Julia. Is that right?
Yeah, I mean, Lendlease is one of these ones. I like the idea behind it, the urban renewal projects. It has some really high profile projects going. So looking at One Sydney Harbour at the moment, the Tower 2, but we haven't heard much of an update. They have a major project which should be sold. They were looking at an anchor tenant before they looked at a sale of that one over in Docklands. And we haven't heard much around that. And of course, we still need an update on One Sydney Harbour as well. So this reporting season, we should see an update coming through from Lendlease. This is one of those companies that scares me. It either blows the lights out or it comes out with a downgrade. Yeah. And of course, behind most of those downgrades has been its engineering division. That hopefully we see the residential property part really propping up its profits this time around, because we know that the residential property part has been strong. I'm a bit more worried about more of its office type of assets, because I've been hearing around the traps that there are tenants which are decreasing floor size, even in areas like Barangaroo where it's premium office space. So look, I'm probably neutral on Lendlease here. I'd probably be more comfortable buying in after reporting season and getting an update on some of its major projects.
Yeah. A company like McPherson did well during the lockdown, lost its CEO. Have you got a view on McPherson?
This is an unusual one. So looking at a skincare company, it has manicure products as well. So if you have a look at the distribution print. It's mostly through pharmacies. So if you go into pharmacies, you can find a lot of McPherson's products in there. But also they have been exporting to China and to other places in Asia. And unfortunately, their sales have been coming under pressure because of that China link as well as that Asia link, which has been the weakest link, I think, in terms of its sales. Now, they have seen takeover offers coming through in the past, and the most recent one was at $1.60. But the company, while doing due diligence, I guess decided to walk away from that bid. And as a consequence, we've seen the share price falling back down as well. So look, I think this is probably one that's a bit more of a COVID-19 recovery play. Certainly if they're able to see earnings bounce back and sales bounce back, then you'll see a pretty strong dividend yield. So you're getting in early if they recover. But beauty is one of those areas that usually quite consistently grows and is still a pretty defensive sector as well. So look, at these levels, it does look pretty risky, but I'd be willing to put a little bit of money in here.
Okay, let's go to Pushpay now. Sorry, Pure Foods Tasmania, PFT.
Yeah, I love pate and I love food, especially from Tasmania. Some of the best dairy, steaks, lobster, seafood in the world. But I have to admit, Pete, I haven't seen this one. It is a smaller play, so I don't really have a view on Pure Foods.
Okay, let's go to Pushpay, PPH.
Yeah, I think Pushpay, it did really well because it was winning these big contracts out in the US, but I think it's really saturated that giant church market. So now you're looking at them having to sign up smaller churches, which I think is a more difficult and expensive task to do. So I think the easy hanging fruit has already been picked here. I'd probably look for other opportunities, given that it is going to be harder to find the type of growth that they've seen in the past few years, where they were signing up those mega churches. So when you're moving on to mega churches to regular churches, unfortunately, there's not as much cash in there. And of course, you have to do a lot more footwork to try and get to the level that those mega churches were as well. So probably a pass, probably peak growth for me.
Yeah, and also a lot of those smaller churches, pastors or reverends, probably want to see people actually walk through the door and put the money straight in the can or the plate rather than have it all registered online. But that's just me thinking that.
Well, that's the other thing with COVID-19, church revenues have to have been impacted. I mean, there's less people being allowed to go to church a lot of the time because of COVID restrictions as well. So I don't know, Zoom's not exactly the same when it comes to that emotional connection you sometimes need to part with that hard-earned cash.
Yeah. Now the last one's a very easy one to explain. Nuix.
Yeah, Nuix still looks like it's coming under a bit of pressure. I think the tech space in particular is an interesting one because in the month of June, tech has actually, I think, been the best performing sector or one of the best performing sectors. So for a lot of investors, the big question is, do they jump back into tech now? And I guess the link here is with underlying interest rates. What we have seen is yields falling. And of course, growth does really well when yields are falling. And we've seen that once again today where the tech sector has outperformed despite the market falling around about 2%. So if you were investing in the tech space, I'd probably go with the best rather than the worst. Nuix is the worst at the moment. So this is more of a bet. If you're a betting person, put some money in there. But just be aware of where interest rates are headed because the growth sector of tech really does follow interest rates. And if interest rates are falling, it's great news for the sector. But if they start to climb, bad news for the space.
So from your point of view, if you were invested in Nuix and you'd lost money, this is one you'd be happy to sell before June 30.
Yeah, I'd probably be looking at some losses. I mean, stocks that I like at the moment are ones with like tailwinds coming through. So I like G8 education because of the strength of the jobs market means that more people will be looking for childcare. Still looking relatively cheap around that $1.03 mark. If you're looking for a takeover play, I'd probably prefer Iris to AMP. Only because, it is expanding in terms of the UK. It does have leading positions in some of its products. And although its major product here in Australia and New Zealand has been declining, there is still some potential there from a technology perspective. So look, I think there are still plenty of options in terms of the market at the moment.
Yeah, and a mate of ours, Michael Blomfeld, is the COO at Iris nowadays.
Yes. My old boss.
Yeah, but I don't know if he wanted to be taken over. Anyway, great to talk to you, Julia, and we'll
Thanks,
talk next
Pete.
week. See ya. Bye-bye. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, we're in June. A lot of people sell off in June, getting rid of those stocks that have lost money on to offset some of the stocks that have made money, and they can effectively reduce their capital gain. Then some sneaky people then turn around in July and buy them again. But let's concentrate on the stocks you might want to sell because they've let you down. Adam Dawes is going to run through a number of stocks I've put to him. Adam, thanks for coming to the program.
Thank you, Peter. How are you going today?
Very good. Well, the market's down today, but I just think it's kind of, well, I think it's ridiculous. Well, let's talk about this quickly. I just think it's a ridiculous reaction to someone with an attention deficit disorder, namely James Bullard, who said, oh, no, interest rates might rise in 2022, and the market then overreacts.
Look, I mean, we've had such a fantastic run over the last 3-4 weeks. Like it's okay for the market to pull back a little bit. It's okay for the market to have some kind of breather. And this is what happens. It takes us 3 weeks to get up. It might take us a couple of days to get down. But all in all, everything is still intact. So I've had plenty of phone calls today, clients asking me about what do I do? Where am I going? What's the market doing? I said, look, calm down, relax. This is normal part of market movement. So I'm really happy with what's going on today. It's exactly what we need.
Yeah, buying opportunities will emerge, right?
I agree.
Okay, let's go to the first. I call them a dog stock. I love dogs. Dogs are better than human beings. So let's call it a human being stock, AMP. like most human beings, AMP has let us down. Yeah. Should we sell AMP and just use the losses to offset our capital gains?
Yeah, yes is the answer. I don't think you can really, I've been fairly vocal in the press about this one. I think you don't need to be holding this one. This thing has got a long way to go to the downside. Look, even if they do sell off some of their parts of the business, even if they do come out and sort of talk about, what they can actually do, look, I don't think this is one you want to own. And it's really a great time to take some losses here before the end of the financial year. And then move forward. So yes, it's a sell from me.
Yeah. Let's go to Lendlease now, a company that's a good company and a lot of good potential developments out there, but the market doesn't seem to want to get cozy on Lendlease. Is it a stock that you might sell in June and maybe July or August think about buying it again?
Yeah, it's not a bad call, actually. I mean, I think that the market has a chance that Lendlease could miss their full year 2021 forecasts. And if they miss that, then certainly this thing will continue to move. The market's sort of thinking that 2021, they're sort of looking at sort of profit around 500 mil, which is broadly in line with expectations of the market. But if they do miss, and they could miss by around 100 to 150 mil of profit, then yes, this stock could be sold off even further. But one of the things is that we certainly see this one as being, the Barangaroo. They've got some fantastic projects going forward, even the Google sites in the US. This one's actually one that I think that you'd hold on to. I think that this thing can do very well. It has been sold down on their engineering division. Now they got rid of that engineering division. Now I think the market's just got to gain a little bit of confidence with them. It is in the bit of the naughty corner at the moment. I'd probably hold on to this one, Peter. If going forward, I think you should be mindful. These guys can come back pretty quickly if need be.
Now, here's a company that did really well in the lockdown period called McPherson. The CEO had high hopes, and the CEO then got the bullet, and the company has not recovered. Does McPherson have potential upside, or is it just a lockdown stock?
Look, it's a sell. Our analyst covers this one. He's put a sell on it. He's got a valuation of $1.54, which is above where the share price is today. However, it is still a sell from our side of things. I call this the third drawer company. Everybody has something in the third drawer of this one, whether it's the cellophane or whether in your bathroom you've got the hairbrush or those kinds of things. This is the third drawer business. Look, I think this is quite cyclical. It is below. I think this one had a takeover offer on it as well. So, I think it's a little bit below what we think. I think it's a sell from me. I don't think you need to be in this one, and there's better value elsewhere on that one.
Okay. Next one, PFT is Pure Foods Tasmania, isn't it?
Yeah, it is. It's an interesting one. I mean, obviously they've got a fairly large growing customer base across their distributions across Asia and whatnot going forward. And they have sort of forecast revenue, albeit from a very low base, revenue or sales revenue for 2.1 million, up about 35%. And, we are looking across strong revenue growth going forward. This is a bit of a tough one. It's a smaller one for me. It doesn't look too bad on the charts, to be honest. Yeah. Look, I think it's okay, this one. I believe that this one should do all right. I think it does have a growing customer base. I think you'd hold on to this one. I think they've got cash in there, about 2.7 million as well. Look, if you own it, you probably hold on to it. I don't think you'd be selling it this side of June 30.
Yeah, it looks like a reopening stock to me. When you get all the foreign tourists back and they want to eat Tasmanian food and all that sort of stuff, that's an interesting one. Let's go to the next one. PushPay. PushPay is an interesting company, isn't it?
Yeah.
Had a lot of people that loved it for a while. It's sort of linked into the American revivalist church fraternity, isn't it? And it's a digital way of these churches getting the collections that usually go around the plates on Sunday. Yeah, it hasn't lived up to potential, has it?
No, the book growth, or the loan book growth, or the front book growth is what we call it, has been materially softer than first forecast. And then the back book growth hasn't been enough to offset some of the slow growth on the front book. So a lot of brokers have downgraded their indications or return. They've downgraded the return or the opportunity for that cross-selling, because look, it's a fantastic sort of idea. I mean, instead of cash going through when you hand the tin around as such, this is all sort of online kind of thing. And look, I guess this is what we worry about with these tech stocks, because it's got a great story, it's got a great purpose, but then can revenue actually then come through? And I think that's what the issue is with these ones, is that, from the dot-com boom, where we saw these fantastic business, but revenue didn't come in, I think this is exactly the same. I think customer growth has been disappointing. Management spoke to earlier positive indicators on how they're going to do that, but it is really hasn't really held up to the name. I know that there are a couple of brokers that have gone neutral on the story, and I think, look, I'd follow those brokers. I think that this one is probably a sell here, basically wait till this thing finds a level and then come back into it. But look, the story is fantastic. I just don't think you need to be there in the short term on this one.
Okay, and finally, the very controversial Nuix.
You've left the best till last, haven't you?
Yeah, and it's a good story. Like I could not come near this company when it was $11 or whatever, but once they started selling it off, I went in, and then more bad news came. But I still think it's a very good company. It's just that the management were hopeless, and there were a few sort of dead bodies buried in the business story that the prospectus didn't really underline effectively. But I'm trying to get past this, and I'm thinking to myself, is this a company I sell now and maybe in a couple of months' time I buy in again? I don't know. What do you think? Nuix.
Yeah, I don't know either, to be honest. I mean, let's 100%. Let's be honest. Look, I think Nuix leadership needs an overhaul, and I think that's the first necessary step into getting to market confidence back into this stock. Yeah. The departure of the Nuix Chief Executive Officer and Chief Financial Officer are necessary to restore investor confidence in this investigative analytics software company. I think such an overhaul, as quick as it can be, but soon after the IPO is highly unusual, but it does represent a constructive step forward in making sure that this business starts to move forward. I think near-term revenue and earnings remains fundamentally positive for the software business. And I think, you know, if you still hold it, I think you'd hold it. I don't see any, well, I mean, depending on where you bought it, I don't see, you know, there'd be any issues. But I really want to see them conducting a review on the business and defending, or at least coming out and saying, this is something that we're comfortable with. And I think management needs to go, basically. And I think they need to get some more experienced people in the board to take this going forward, because there has been so many disruptions going forward. And really, ASIC have come in and they'll probably do some more investigations on this business going forward. So look, fundamentally, I think the business is sound. I think it's a great idea. I just think you need to get rid of management because they haven't been able to run this business going forward.
Yeah. One last one before you go. I must admit, I was always sweating on a comeback for tech stocks eventually. But were you surprised how quickly tech stocks have come back?
Yes and no. I mean, you know, we sort of saw the sell down from tech and the value starting to move higher. We sort of saw we saw the banks, you know, Commonwealth Bank getting to $100, $106. You know,
Yeah.
You probably thought that value trade had sort of come off. Then we saw Altium getting a takeover bid. I think there's something else that got a takeover bid as well. You know, that's the sort of the bottom feeding guys taking opportunistic when the share prices are lower. You know, I mean, this market is pretty efficient. So, you know, yes and no is the answer to your question, Peter. I think it's well deserved that this overall, these tech stocks have started to bounce back, because there's some fantastic businesses in this market, and they deserve the premiums that they've been previously had.
And I think the bottom line for me was, when they were really being smashed, I thought, these are businesses of the future. If you can buy them at low prices, and I should say, let's give you a bit of praise, both you and Julia liked Altium a few weeks ago before the takeover offer, which means that you're not wasting our time. So thanks very much for coming on the show.
Lucky, hey?
Yeah, for sure. Thanks for joining us, Adam.
All right, take care. Thank you.
I want to talk to you about the Switzer Golden Ticket promotion. Yes, our marketing department has been working overtime to come up with something great, and I think this is great. How would you like to win a free 1-year subscription to the Switzer report with all the great stock tips that the report produces on a weekly basis? Well, we are giving you, our loyal audience, the opportunity to do just that. From now until June 30, with every purchase of my book, Join the Rich Club, which is 50% off until the end of the month, you'll enter your chance to find a golden ticket. Yes, a golden ticket, and you will win a free 1-year subscription to the Switzer report. So if you're a current Switzer report subscriber and you find one of these golden tickets, then we'll just add another 12 months onto your existing subscription for free. How good is that? We've got 5 of these to give away, so get in and good luck. Well, today the Aussie dollar is at 74.55 US cents, and the man who called it absolutely right a year ago, Michael Knox from Morgans, is joining me now. And I want to know whether he's called that it would go all the way into the 80s is still on the cards. Michael, thanks for joining us.
Good morning, Peter. And thank you for putting me on this spot right now. And I look forward to being put on exactly the same spot this time next year.
Yeah.
The simplest way to unwind the Aussie dollar is that we've always thought of it as a commodity currency. And if you go and you look at the RBA index of commodity prices, you'll see that they're up in SDR terms almost 40% in the last year, and metals and bulk metals prices are up 50% in the last year. And if you put that into a model together with the relevant interest rates, Australian interest rates and US interest rates, you get a fair value of in the high 80 cent level, let's say 88 cents. And so that's where the fundamental value is. I mean, these are commodity currencies. So the question is, why is it sold off in the short term? I think there's a whole bunch of plausible reasons. The most frequently talked about is there's the last Fed meeting. But I watched that Fed meeting in real time, and I watched it. I rewatched what Jay Powell said a couple of times, and he didn't intend to tighten monetary policy. And he explained in a number of questions that he wasn't tightening monetary policy. They weren't changing the pace at which they were buying assets. They weren't going to change the Fed funds rate before the end of 2023. The dot points in the survey, the summary of economic projections, did show that rates might go up by 50 basis points in the second half of 2023. But that's more than 2 years away. And as Jay Powell himself said in response to questions, that when he himself joined the board as a ordinary member rather than chair, at that time it was thought that according to the summary of economic projections, rates would go up in 2 years' time, and they did absolutely nothing. So he went out of his way to show that that didn't actually mean that the Fed was on any tightening cycle. It didn't announce that, but the market has reacted as if it did.
Hang on, Knox. Are you trying to say seriously that people with economics training such that they get on the board of the Federal Reserve can actually make a mistake about interest rates? Is that what you're trying to argue?
Well, I don't think that. No, I think that the people who are reporting on what Jay Powell said have put a spin on it that wasn't what he intended. That's what I think.
No, I'm talking about the other people with their dot points, guessing where the interest rates will go up and when. Like that's like trying to pick the winner of the Melbourne Cup, which you're actually quite good at doing, but you don't get it right every year either. So it just seems to me that it's a ridiculous reaction by the market, but we expect that. We see ridiculous reactions by the market all the time because short-term influences are far more important than long-term influences on the stock market. But I think the most important question I want you to answer today is, given all the crap that we've seen over the last week around interest rates, do you still think that the Aussie dollar will creep into the 80s over the next 6 months or so?
Yes, absolutely. And as I say, the simple way of supporting that case is to ask people to go and look at the RBA website and look at the chart of the export commodity prices and see the way in which it's rising rapidly in exactly the same way as it did in the last resources boom. And the last resources boom, as we recall, generated much higher levels of the Australian dollar. Now, it is obvious that the RBA is trying to slow that rise in the Aussie dollar. But as we've said before, the RBA will be able to break the rise in the Aussie dollar. We'll be able to slow it, but not stop it. It's just that commodity prices are far too strong.
Yeah, and Michael, it seems to me that America, the monetary authorities in America, haven't been as aggressive in saying they're going to fight interest rate rises as Dr. Phil Lowe has been, because Phil Lowe has been re-emphasising 2024 on many occasions, which belies his actual name. Well, they said, no, he's consistent with his name. His name is low and he's keeping interest rates low. If his name was Dr. Phil High, he would be allowing the dollar to go up higher.
Peter, can I use that one? Can I use that one?
You can have that one. But as long as you credit me, so Switzer came with this one first. He's ripped me off on plenty of occasions. But all right, so, that to me is the difference between after the GFC, when the Aussie dollar did go up to about $1.10, $1.12, the Reserve Bank wasn't fighting hard against it like Phil Lowe has been.
No, absolutely the case.
Yeah,
absolutely the case. But also, I think what I saw in the reaction to the Fed meeting from the journalists that were in the room, there was one question which was to Jay Powell, which was, but if, and it started with a but if you add up these numbers, the inflation numbers that are in the summary of economic projections for the next 3 years, on average, they are above your target of 2%. And Jay Powell looked almost tired when he answered the question. He said, yes, if you look at what we started saying at the end of last year, we said that we would allow inflation to run above the target for a significant period. And that is what we are doing. And I think that the journalists were shocked to find that the Fed actually meant that about running inflation above the level for a time. And if one looked at the inflation number for this year in the summary of economic projections that the Fed released last week, it's 3%. If you have 3% inflation and you don't move short rates, well, what you are doing is you are cutting the real rate and you're providing more support, not less support. You're providing more support to the expansion over the next 2 years.
Yeah.
But he also explained things like, he talked about, was asked questions about and talked about the employment recovery in the US. He said the recovery is very, very strong, but he pointed out the participation rate is about 0.3% lower than it was in 2019. And that's for a bunch of reasons. That people are out of the workforce because of high unemployment benefits, or they can't get their kids into public schooling, which hasn't opened for in-person schooling until about August. And that meant that there was a lot of people providing childcare for their own kids. And when everybody went back to school and everything became normal, those people could return to the workforce, and that would release that problem that was people asked him about in the workforce. But he was talking about how strong it was, and he was talking about how the Fed really wasn't changing policy anytime in the next couple of years.
So let's talk about inflation quickly. A lot of people are being shocked at the numbers they're seeing for inflation. Are you firmly in the camp that this is going to be temporary, transitory, and then inflation will fall?
Well, we've made the same point that Jay Powell made in answer to questions about this on last Thursday morning our time, Wednesday US time. And that is that what's happened is that in core inflation, there are a couple of things which are include things in the automotive industry. What I've said about this is you've got high inflation because the US economy is literally moving again. And you've seen a dramatic acceleration. He talked about the dramatic acceleration in used car prices. And there's also been a dramatic acceleration in hire car prices. Now, both of these things, we remember the oil prices fell down to absolute zero last year, and they're coming up from a very low base. But also things like used cars and hire cars collapsed to close to zero price and are coming up from a very low base. He said those things are adding to core inflation right now, but that will disappear.
Yeah.
And if you actually look at the last 2 monthly numbers, the inflation number for the previous month was 0.9. The inflation number for the most recent month is 0.8. So you can see this peaking of US core inflation that Jay Powell was talking about.
Yeah, and Knoxy, I've done 2 flights recently, Adelaide and Cairns. If I'd inquired 6 months ago, they would nearly beg me to buy the ticket at a really low price. You see the price they're charging you now, they know you're desperate to travel and they're charging you accordingly. But in 6 months' time, once we've all been jabbed, if we are all jabbed, I bet you those ticket prices will be a lot lower, there'll be a lot more competition.
I guess that's true.
Knoxy, thanks for joining us, mate.
Thank you, Peter.
Well, I'm joined by my colleague Paul Rickard, who's taking a bit of a look at term deposits, interest rates, where they're going, and other fixed income investments. Paul, thanks for joining us.
Thanks, Peter.
Now, you've written a piece today for the Switzer report. What's the guts of your conclusion?
Well, first of all, the good news for term deposit investors is that rates have bottomed, but they're not going up anywhere quickly.
How good is that good news?
So if you're happy with 0.3 or 0.4% if you can find it, well, you're stuck with it. I mean, the Reserve Bank will push up interest rates, and it will be before 2024. It will happen, I think, towards the end of next year or maybe sometime in early 2023, Peter. But that's still a long time away. And for the next 18 months, you know, we've got, when the Reserve Bank continues to buy 3-year government treasury bonds at 0.1%, it means it's very hard to get much of a return, and the banks won't need to get too aggressive. So you're going to have to take on, if you're not happy with term deposit rates, you're going to have to take on some more risk.
So you're going up the risk curve. So where do you go to after that?
Well, let's sort of deal with what I describe as the least risky to the most risky first.
Okay.
So I've sort of got 4 categories of investments. The first one are what I describe as the traditional bond funds. So they're basically investing in either government or you know, investment grade corporates.
Yeah.
So
State governments,
yep, state governments, federal government, of course, is the biggest borrower. Some major corporations, all investment grade.
Yeah.
Look, not a lot of return, because the key number to look out for there is what's called the yield to maturity. It's typically in the ones, right? If you're lucky, you know, if you go for some investment grade corporates, you might get towards about 1.5%, but the returns are pretty low. The other risk you take on, of course, in these sort of funds, and you can buy them on the ASX through a lot of the exchange traded funds, all the major issues, people like Vanguard and iShares and Beta Shares have got them, is that if they have what's called a very long duration, that is the type of bonds they're buying have a long term to maturity date, you actually take on quite a lot of interest rate risk. So if the interest rates go up and bond yields go up,
which is the tip now.
yeah, you can see your capital value go down. So I would still keep them reasonably short, because I think longer term bond rates are still going up. Yeah. That's what's likely to happen over the next decade. And so I think you can look at things like iCore from iShares, and Vanguard's got a similar product. Just stick to the investment grade corporates and try not to go too long in terms of duration. So that's pretty a little more risky, but not super risky. The second option is look at some of the bank hybrids. So these are the sort of what are called the capital notes that the major banks issue. They count as part of their capital, and that's why they're called, given a name as a capital note. But they're really like I describe as a floating rate sort of note, an interest-bearing security. Now, they're not government guaranteed, and if we have a major banking crisis or one of the major banks has a big misstep, you could lose some capital. But you're not going to make any more, so they're not like a share. You're not going to put in $100 and get $150 back. It just doesn't happen. You won't get any more than what you put in up front.
Right, so your capital hopefully will remain stable, but it might not. But what kind of returns do you expect?
Yeah, so the current return grossed up is about 3%. Now that includes franking credits.
Which makes them really more.
No, that includes the franking credits. So the cash return is going to be about 2.1%.
Okay.
And that's floating. In other words, it's going to reset every 90 days. And if interest rates do go up, that rate will go up.
Yep.
Okay. Plus they'll be fully franked. So a gross return of 3%. I don't think there's a lot of risk on these. There's ANZ currently has an offer on the marketplace. If you're an ANZ shareholder or you've bought an ANZ capital note before, you can go to the ANZ website and apply directly. Closes on the 30th of June, or you can buy them on the secondary market. So a little more risk, but they're a little complex, and as we always say, don't invest in something you don't understand.
Correct.
So there's good information on our website. You can go to the ASIC website, the Money Smart website from ASIC, and learn all about hybrid security. So that's category number 2.
Yeah. All right, Paul, let's go up to the yield curve to the next level of more risky, but fairly good investments.
Yeah, the next category, and there's a bit of equity in this, but this is what I describe as a listed infrastructure funds. Now, we have some securities in Australia that are essentially single asset or in a very small class of assets that you can get involved in Australian infrastructure. Things like Sydney Airport gives access to Sydney Airport. You can buy Transurban, it gives you access to a lot of toll roads. But we don't have a lot of infrastructure funds that just invest in Australia, mainly because the pool of assets is pretty small.
Right.
And so, but there are some Australian listed assets on the ASX that invest in global infrastructure. Yep. And the two biggest providers are people like Magellan, which has what's called the Magellan International Global Listed Infrastructure Fund, trades under the ticker of MICH, and also Argo has a fund called the Argo Global Listed Infrastructure Fund. And these funds buy infrastructure assets around the world, so railways, toll roads, airports, utility stations, power stations, from some of the biggest providers across the world. Typically have between about 40 and 100 securities in their portfolio. They're generally hedged back into Australian dollars, so you're not taking a lot of currency risk. And you should accept a reasonably steady sort of capital performance, a bit of risk, and a return of somewhere between about 3.5% and 4%. Now, it's not going to be franked, so you have to pay tax on it, and there's going to be some risk in the share price because, we saw...
Markets can fall.
Markets can fall. And so even when falling markets, like when you have what we saw last February, March, when we had the
Coronavirus crash.
Corona crash, infrastructure assets also fell in price too, as did a lot of property trusts. So, look, I like both of these. There's Magellan, there's one from Argo, which trades under the ticker ALI. There's also one of the, I think Vanguard's also got an ETF that tracks a global infrastructure index. So, more up the risk curve, higher return, but relatively stable on the capital. And then the final category, Peter, are the listed credit funds. Now, there's about 8 listed credit funds. So these are funds that are investing, again, globally in the securities of corporates, but these securities tend to be of lower quality. In some cases, they're not investment grade, so they're from lower ranked corporates, or they can be things like mortgage securities or developer loans. And there's about 8 listed credit funds on the ASX, people like NBI, which we're familiar with, and Neuberger Berman.
Yep.
There's also KKR, there's Perpetual's got a fund. There are things
Metric
like
Partners
Qualitas, Metric Partners does a lot in terms of the real estate. Here your returns are going to be between your distribution return between about 4% and 6%.
And your capital can go up and down.
But your capital go up, and not just your capital, but also because the market value can change quickly. So we did see in, as I said, go back to last February, March, some of these funds lost 40 to 50%, within the space of a couple of weeks. Largely recovered it all since. But the price can go down, and in many cases where it was trading on the ASX didn't reflect the underlying assets. It was just that there was a bit of a fear factor, and sell everything. People sell everything, right?
Yeah. Yep.
So there is more volatility, and again, you probably wouldn't want just one fund. You'd want to diversify across a couple of managers to spread some of that risk. So I think there's a role in every portfolio for some riskier fixed interest, but you are going up the risk curve. There is more risk of loss. There is more risk of price volatility up and down, but that's what you need if you want to get a higher return.
Okay. Well, where does the Switzer high yield fund fit on that risk curve, Paul?
Yeah, look, that probably sits somewhere between in the first category, Peter. It's investing in very investment grade corporate securities only, and I excluded that just to be in fairness. So
you weren't biased, but I was just interested to see where you place that.
And that trades under the code of SHFY, Switzer Higher, SHYF, sorry.
SHIFE, I call it.
SHIFE, got that well, didn't I? And that's investing in very investment grade and government securities, and generally very little interest rate risk, so it keeps it very short. So definitely in the first of those 4 categories. So that's one to look out for there as well, Peter.
Yeah, okay. That's Paul Rickard. If you want to look at that report in detail, have a look at the Switzer report. Go to switzerreport.com.au. Finally, before we go, let me invite you to register for the Small and Micro Cap Conference on tomorrow. Click on the link in the description below. You'll see some interesting companies where the CEOs will describe what the outlook is for their businesses. So once again, click on the link in the description below, and I hope you can join us tomorrow.